back in the 90s, I started and managed the hedge fund sales business in equities and equity derivatives for Goldman Sachs. I then, in the early 2000s, went to GLG Partners, which is now Man Group, which was the largest hedge fund firm in Europe at the time, where I started and ran their global macro hedge fund. Then I moved to the Mediterranean coast of Spain, sort of semi-opted out of the rat race, and started writing macroeconomic research for the world's biggest global macro funds, hedge funds, sovereign wealth funds, family offices, that kind of thing. So my background's basically 30 years of global macro. Then I'd gone through the financial crisis in 2008, and I was, one of the people who was kind of at the epicenter of predicting what was going on. A lot of people in the film The Big Short were kind of clients of mine, and I kind of knew a lot of how this might play out. The same happened in 2012 when Europe almost fell apart. So I was thinking, why me, living in a beach town in Spain? How come I've got all the access? And people in the street would come up to me and say, well, why didn't we know? And I thought, there's something wrong here with the distribution of information, that only some people get it and others didn't. And that's why I started Real Vision. So Real Vision is basically a video-on-demand platform. It's actually larger. It's now a broader media company that basically concentrates on helping other people gain access to the world's most preeminent intelligence, financial market intelligence. And we do that by interviewing the world's most famous hedge fund managers, independent analysts, strategists at length. Also in that journey, so I had a journey that I wanted to help educate, level the playing field, and understood that the world had changed away from the intermediaries to a disintermediated world. And I wanted to play a part of that, and video was the big answer. But in that journey, having gone through those two huge crises so close to each other, and having almost lost the banking system in Spain, I started a journey of trying to figure out, could I set up the world's safest bank? I know that's a slightly kind of crazy, arrogant thing to think, but I thought I'd give it a go. So we got together with a bunch of others, and we went around the world to Singapore and the Middle East and to Switzerland and the US trying to do this, and it became hard. And one of my clients at the time kind of tapped me on the shoulder and said, you should look at Bitcoin. Maybe this is your answer. So this was 2012. And so I learned about it. I invested in it for the first time. It went up 100% in a month. And I closed my position, took my money and went, wow, okay, this is not normal. And then I kind of did the first analysis of stock to flow, meaning I looked at it like gold and thought, well, with this much supply and this much gold above ground and this much known reserves, if we imputed the same thing for Bitcoin, when gold was at 1,300, Bitcoin should be at 1 million. So I'm like, okay, this is interesting. This, from a macro perspective, looks cheap. So that started my whole journey. And I also realized that after 2012, the next global recession would see this parallel financial universe using blockchain technology meet this macro world of excessive debts, a financial system that's somewhat fragile, and all of these things would have a horizon point. And that all happened last year. So at top level, the internet grew at an adoption rate of 63% a year from 1999 to 2000. That was the fastest adoption of any technology the world had ever seen. Crypto, in its broadest sense, is actually growing at an adoption rate of 113%, twice the speed of the internet. So this is of an order of magnitude none of us have ever seen before. And most of our narratives are somewhat behind what's actually happening because so many people are working on this. But what I think is going to happen to the financial industry, I think it's actually going to change all global business models. But to the financial industry, we know some of the big problems that have been outstanding. Things like rehypothecation. What happens at things like DTC level, CC level, or Euroclear? Who owns what asset? The ability to tokenize these assets is a game changer. And the ability to trade 24 hours a day instantaneously and fractionalize it is also a game changer. So I can't see any reason on earth while all equities and all bonds are not going to go into the blockchain. We've also seen the rise of DeFi, and that's decentralized or somewhat centralized lending protocols and borrowing protocols that work algorithmically, seem to be pretty robust as far as we've tested, and that looks like that will scale as well. So what we're doing is we're creating a modern system of finance that's more accountable and suitable for the modern age, that doesn't have T+1, T+2 settlement, but instant settlement, that allows the instant transfer of assets. And once you blend in the central bank digital currencies, you've got rails of which all of this can operate globally. So if we think of the size of the asset class today, and Mohamed said, it's around, or you said that it's somewhere around $2 trillion. If we look at the global equity market, the global bond market, global real estate, which can also be tokenized. All of these things, they're between 100 and 200 trillion dollar assets. If we look at the adoption rate, it's kind of suggesting to us that this blockchain technology is going to end up as a 100, 200 trillion dollar asset. I think it actually encapsulates all of these other asset classes because it's a much more efficient way of transferring, owning, proof of ownership, all global assets. So I think it's really big and it's hugely disruptive. As Mohamed said, we don't know actually what format the central banks are going to do this. My guess is they'll start with the non-disruptive version, as he suggested. I think they will move towards the disruptive version. We're already kind of getting noise of that out of the US, that maybe they want to do it in conjunction with the private sector. Maybe DeFi is an efficient way of doing it and fintech is an efficient way of doing it. Do we need money center banks? Okay, that's a big change to the world. Or money center banks have to reinvent themselves. That's fine. That's what technology does. It strives all of us to improve our business models or adapt. So, yeah, look, it's really exciting times for finance, and it's bigger than finance itself.
So what's the mood around digital currency, digital assets, with the investors that you're speaking with?
It's fascinating because we've just gone through this 50% sell-off, and normally in markets, 50% sell-offs create a different investor psychology. I've not seen it. You know, I spend a lot of my time speaking to these world's largest hedge funds. You know, I present to a lot of asset management firms, the entire firm, all of their portfolio managers. And I've done that around the world for various people, helping them understand, you know, the benefits of holding some of this stuff in portfolios, for example. And I see nothing but ongoing adoption. I don't see anybody. I see people being slowed down by the ESG story, and I think you'll see over the next few weeks the Bitcoin miners getting together to create a better understanding of what's going on and how it works. So that regulation. People are waiting for more regulation, as Mohamed said, because some people need clarity. A lot of the hedge funds don't, but the institutional asset managers do. I see nothing but people thinking that it diversifies their portfolios and has great portfolio effects for them. They don't need to allocate a lot of money, and they don't need to make the decision that we're all thinking about, is how big is this disruption. They just can make the small step. Most haven't made the small step yet. The hedge fund industry and the family office industry has. The asset management industry is only just starting. The first step will be Bitcoin, then probably Ethereum, and then it'll be an open conversation of, can we treat this like real-time mark-to-market VC? And can we bet on protocols, tokens, and ideas that may disrupt our whole industry? And so therefore we benefit from the disruption. And I think that's where it's all going to go.
The exponential age. So how do you think technology and digital will transform our everyday lives?
I think many investors misunderstood what happened in the last 20 years with these big stocks that came out of the birth of the internet. Google, Facebook, Apple, and there's a whole bunch of them. I spent a long time trying to understand what that was. What really happened there? Why did we all misjudge it and say, well, it looks ridiculous. Amazon's worth more than every bookseller in the world. This doesn't make sense to me. And so many of us missed it. And the reason being is I think the global business model changed towards network effects. So when you use Metcalfe's law to value the value of a network, it's very different than using net present value in cash flows, right? We all got that wrong. The market got it right. But now we're in a situation where we've just invented cryptocurrencies, which are actually entirely driven by network models, and the key benefit that the model derives is the value of the money goes up. Okay, that's a very powerful model. But that's also happening at the same time we see massive adoption of technologies. So we're going to go from very few electric cars to, by 2030, 65% of every car in Europe being electric. We're going to see a mass change in how we generate electricity, a mass change in distributed computing power, a mass change in genetics, robotics, artificial intelligence. These are all adoption model businesses, and they're all coming at the same time in a 10-year period, which will be the fastest pace of change any of us have ever lived through. It's going to be quite hard to navigate, but also incredibly rewarding if you're on the right side of this. If you realize that the worst words in finance, this time is different, that this is a different model, and network models are very different than cash flow models.